Hello, I want to talk a little bit today about adjusting journal entries. Let me go ahead and share the screen. So I've already worked out some things, but I kind of want to talk through them and kind of explain adjusting journal entries. Now, adjusting journal entries, they're completed at the end of the period after all the normal transactions have been posted, but before a company produces their financial statements. Now, they follow the accrual basis of accounting. And a lot of the purpose of the accrual basis accounting is to recognize the revenues that need to be recognized, to recognize the expenses that need to be recognized before you do your financial statements. So they're setting the expenses and revenues correctly in order to have better financial statements or more accurate financial picture of the performance of the company. Now, there's some rules with the adjusting entries. They never involve cash, and they always involve either a debit to an expense or a credit to a revenue. And again, it goes back to their purpose is setting the financial, or basically correcting or setting the revenue and expense accounts to where they should be in order to have more accurate financial statements. Now, what I'm going to do is I've worked through some examples here and I'm going to talk through these and kind of explain them. There are 7 different examples I'm going to work through. And these are very typical examples of what you will see in relation to adjusting journal entries. So what I would suggest is be familiar with these 7 and how they work, because they're the 7 types that you're going to see really over and over again. So the first one would be prepaid insurance. Now, this could also apply to prepaid rent. And if it was prepaid rent, it would be handled in a very similar manner to prepaid insurance, just the account would be prepaid rent instead of insurance. So what we're talking about here, and it kind of falls under prepaid expenses, are any expenses that you pay in advance as a company. You cannot recognize the expense until it's been incurred. Remember that the rule for expense recognition is it doesn't matter when the expense is paid, it matters when the expense is incurred. So if you pay a year's worth of insurance in advance, you can't recognize the insurance expense until every month passed by, because that's when the expense is incurred. And that's the rule of expense recognition. So let's say, for example, on January 2nd, a company paid $2,400 for 12 months of insurance. Now, prepaid happens a lot with insurance because you have to pay in advance, sometimes with rent because a company might be required to pay rent in advance, and also a lot of times with advertising. A company might be required to pay advertising in advance. So again, with all 3 of those types of expenses, they all could be handled in a very similar way to what we're going to look at here with insurance. So our original entry on January 2nd, whenever we prepay the insurance, would be we would debit an account called prepaid insurance for 2,400, and we would credit cash for 2,400. So we paid 12 months of insurance in advance on January the 2nd for the entire year. So what would be our adjusting entry? Basically, we would take that full amount, that 2,400, and since we paid 12 months, basically the amount that we would be recognizing per month would be $200 per month. So on January 31st, at the end of the month, we would record this entry. We would debit insurance expense and we would credit prepaid insurance. Now, prepaid insurance is a current asset. So if we pay an expense in advance, we recognize a current asset for it. And as we incur the expense, we recognize the expense and reduce the current asset that we set it up to, prepaid insurance. So this journal entry right here, we would do at the end of every month throughout the year. At the end of February, we would make this same entry. At the end of March, we would make this exact same entry where we debited the expense and credited prepaid insurance. And again, like I was saying earlier, if this were rent, it would be prepaid rent and rent expense. We would do basically the same thing. If it was advertising, it'd be prepaid advertising and advertising expense. It would be handled the exact same way as what you see here. So the first example of an adjusting entry would be related to prepaid expenses, such as prepaid insurance, prepaid rent, or prepaid advertising. Now, the second one deals with supplies. And supplies might be office supplies or factory supplies. They're different things that you would buy depending on if it was for the office or for the plant, that you would use to support what you're doing. And so, basically, um, our original entry, let's say that we purchase $1,000 worth of supplies. And so we purchased $1,000 worth of supplies. Our initial entry would be that we would debit supplies and we would credit accounts payable. Typically, purchases like this are made on account. So you've got a Staples charge, if it's office supplies, and you go to Staples, you purchase supplies, and uh, basically you put it on your Staples charge and you pay it off next month. That's a pretty typical transaction here. Now, the adjusting entry, you might see it in different ways, and we're going to look at it two different ways that you would probably see it. One is the problem might just say we used $600 worth of supplies for the month. And so basically what we would do here is we would debit supplies expense for what you used, and we would credit supplies. And this journal entry really has two different uses to it. It recognizes the expense for what we've used, and it recognizes a reduction to the balance in the asset supplies. So it really has kind of two different purposes there. So we're recognizing the expense for what we use, and we're reducing the amount of assets we have on hand because we've used supplies and we now have less supplies on hand. Now, another way you might see it is you might see it kind of like this. It might say supplies account on January 1st has $1,200, and we purchase another 1,000 over the month. We end the month with 800 in on hand. And so you would have to figure then how much you've used. Now, a good way to figure this is to do a T account. And you would just show, okay, we started with 1,200, we added 1,000, and our ending balance is 800. So how much did we use? For purposes here, I'm going to say we started with 1,200, we added 1,000, so we had $2,200 worth of office supplies available. But we ended with 800, so that means we had to use 1,400 over the period. And so our adjusting entry would be a debit to supplies expense and a credit to supplies. That would basically be our adjusting entry. Now, the third area, depreciation expense. And one thing I'll say is, have you noticed so far, again, kind of the rule that I told you about earlier, the two rules? They never involve adjusting entries, never involve cash. So none of the adjusting entries that we've seen so far, none of the ones that we will see involve cash. And notice that they always involve a debit to an expense or a credit to a revenue account. So our depreciation expense would be the next one. And depreciation, you remember, depreciation, you will see more about depreciation later on in the course. Depreciation is whenever you purchase an asset, you recognize an expense as you use up that asset in the ordinary course of the business. So if you've got a vehicle, as you drive that vehicle and as you use it in the ordinary course of business, you're going to recognize depreciation because you're expensing off the use of that asset in your business. And so depreciation would be considered an adjusting entry made at the end of the period based on what methods of depreciation that you use with your assets. So the adjusting entry, it basically, there's a couple of different ways you could see it, but more than likely, this is the way you're going to see it. It's just going to say equipment depreciation for the month of January is $800. So you would record a journal entry and you would debit depreciation expense and you would credit accumulated depreciation equipment in this case for whatever amount of depreciation that's been incurred. So basically, how it would look on the balance sheet is you would have your equipment account. If we've gone through 1 month of depreciation, then you would have accumulated depreciation equipment for 800, and then you would have a book value, which would be the difference between the cost of the equipment and the current level of accumulated depreciation that you've incurred. Now, one thing I'll say about depreciation is that this entry, if most companies use straight line depreciation. And if you're using straight line depreciation, you figure the amount of monthly depreciation up front, and then the amount would be the same as long as you've got the asset. So more than likely, this same entry for depreciation would be made every month you have the asset, because straight line depreciation would be used. That's the most common one that's used. Now, other thing I'll say is accumulated depreciation here. This is what's known as a contra asset account, and depreciation is recorded to this account and it builds up over time. Now, one of the reasons that you do use accumulated depreciation versus basically just doing a journal entry that affects the asset account is because by doing this, you're better able to get the age of the asset or see the age of the asset. So, for example, in this case, you could tell that this is a very new asset. You could tell that the cost was 40,000. You could tell that they had a very small amount of depreciation has been recognized, and the book value is very close to the cost of the asset. Now, if we only showed the asset and we only showed the asset at 39.2, we could not tell if it was an $80,000 asset that's been half depreciated, or if it's a $100,000 asset that's been mostly depreciated. We could not tell that by the information that's presented. By presenting it this way, you're able to get a very good idea of the age of an asset. The main thing here is just realize that depreciation is an expense related to using assets in the ordinary course of your business, and that the journal entry you're going to recognize for the adjusting entry is going to be a debit to depreciation expense and a credit to the accumulated depreciation for that account. Now, unearned revenue. Unearned revenue, this is the first revenue type adjusting entry that we've looked at here. The others have been expenses. Unearned revenue, what it is whenever you receive money in advance from a customer, you cannot recognize the revenue until you've completed your part of the deal. So if a customer pays you in advance, you cannot recognize the revenue until you've completed the job for that customer. That is the rule of revenue recognition, and that's part of the accrual basis of accounting. And that is you recognize revenues when it's earned, not when you're paid. So if you receive any money in advance, the original journal entry would look like this. Let's say that a company receives a $2,000 deposit for a job on January 2nd. How they would recognize that entry is they would debit cash and they would credit unearned revenue for that amount. They debit cash because they've received the cash. And this is the original journal entry that we made, not the adjusting journal entry. And then they would credit unearned revenue. Now, unearned revenue is a liability account. And you can kind of think of it along these terms. If you accept payment from a customer in advance, you now have a liability to fulfill your end of the deal. And so we would debit cash, we would credit unearned revenue. Now, the adjusting part of it, let's say the job was completed on the last day of the month, on January 31st. Our adjusting journal entry would be that we debit unearned So basically, by debiting unearned, we're clearing it out of unearned revenue. And then we recognize the revenue. So anytime we receive payment in advance, we set it up to unearned revenue. Whenever we complete that job and earn the revenue, we take it out of the unearned and we recognize the revenue. That would be the adjusting entry portion right here. And again, the adjusting journal entry has a credit to a revenue account. Now, accrued salaries expense right here. Accrued salaries expense, what this relates to, and I'm going to go down here a little bit, show the whole thing. Accrued salaries expense, what this relates to is, again, one of the things that you're looking at with adjusting entries, and it kind of goes along again with the accrual method of accounting, is you're looking at matching expenses and related revenues. So if you have employees that work during the month, you want to get, or during the period of time that you're recognizing revenue, you want to get that expense of salaries on the books to match up with the revenue that you're recognizing. So you want to match expenses and revenues. Now, the adjusting journal entry, it might come to you in two ways. So I'm going to do a couple of examples of how it might come to you. One might be you're simply told how much unpaid salaries are out there at the end of the month. So let's say, for example, a company has $3,000 of unpaid salaries at January 31st. The employees have worked, but they're not going to be paid till sometime in early February. So your adjusting entry would be you would debit salaries expense for that 3,000 and you would credit salaries payable. This adjusting entry goes ahead and recognizes the expense for what those employees have worked up to the end of the month, from the last payroll to the end of the month. Once they are paid in the next month, they will clear out the payable and won't have to recognize this expense since it's already been put on the books. But again, it makes sure that within a period that you're reporting revenue, you're recognizing all of the related expenses related to earning that revenue. Now, another way you might see this is company payroll is 10,000 per week and it's paid every Friday, a Monday through Friday work week, so 5 days. And so January 31st falls on a Wednesday with a payroll on Friday, February the 2nd. So if you wanted to determine your adjusting entry, you would take the weekly payroll, 10,000, divide it by 5 days. You'd get 2,000 per day, and you'd take that times 3 because Wednesday's the end of the month. So the employees would have worked Monday, Tuesday, and Wednesday, 3 days, and take that times 2,000 per day, you would get $6,000. So $6,000 would be the adjusting entry that you would need to recognize for payroll expense. So your adjusting entry would be a debit to salaries expense and a credit to salaries payable. And then that payable would be paid off or cleared out with the payroll that would be paid on Friday, February the 2nd. Okay, now another one you're going to see on occasion is accrued interest expense. Now, remember, interest is basically what you pay for borrowing money. You know, it's an extra fee that you pay to borrow money. And so let's say a company takes out a 6-month note for $10,000 on January 1st with an interest rate of 12%. They're going to pay it back on July the 1st, 6 months later. The principal plus the interest. Now, the original journal entry on January 1st to record the note itself would be that the company would debit cash and they would credit a note payable. They basically signed a 6-month note. Company gets some money and the company will pay it back, principal and interest, at the end of 6 months. A lot of companies do things like this. Companies that maybe are in a very secular business or that has business that has ups and downs in the business cycle. You know, what if you have a ski resort in Colorado and you need to take out a loan to get through the summer when you don't have a lot of business? or you have a golf course in Minnesota, you need to take out a loan for the winter that you don't have a lot of business. Some businesses, just by the nature of their business, are very secular in nature. So sometimes they have to take out a loan. They pay it back once their business season hits and they start doing more business. Now, so your adjusting entry here would be that you need to recognize the interest expense that is occurring every single month that you've got this money, because you are using that money in your business to earn revenue. And again, it goes back to the accrual basis of accounting. It goes back to the matching principle of accounting, that you try to match expenses with related revenues, or revenues with related expenses. So this would be an example of this. So you want to find out what the interest is going to be. So the way that you figure interest is equal to principal, which is the amount you borrowed, times rate, which is the interest rate you're paying, times time. And time is always based on 1 year. So in this example, I would take the principal, which is $10,000, times the rate, which is 12%, and that would equal $1,200. And then I would take that times time, which in this case it's 6 months, which is half a year. So you see, that's why I've got 0.5 there, and it would equal $600. Now we could take that $600 and divide it by 6 months, and it would equal $100 per month. We could have also done this by basically taking the total by 1/12, and that would have also given us the monthly interest. A couple of different ways that we could have kind of done this. So our adjusting entry as of January 31st would be basically a debit to interest expense for $100 and a credit to interest payable for $100. And we would make this very same entry at the end of January, February, March, April, May, June, and then we'd pay it off on basically July the 1st. We would have at that point recognized all of the expense, so we would just clear out the interest payable when we paid off the loan, because we would have recognized the interest expense every month along the way. So this is kind of an example of how you would see accrued interest expense as an adjusting entry. Now, the last example, and this is probably the easiest one of all, would be accrued revenue. And how accrued revenue works is that typically companies try to complete as many jobs as they can within a period, because once they complete the job, they can recognize the revenue. And so there's a lot of times a rush, and sometimes a job might be completed, at 10 o'clock at night on the 31st. So anything that's during the regular process of recognizing transactions, any revenue items that are missed would be recognized with an adjusting entry. So if something's completed at 10 o'clock after the office is closed on the last day of the month, we would do an adjusting entry to go ahead and get that revenue on the books. If something was completed on the 16th, but we somehow missed it, part of this process would be kind of the adjusting entries, kind of going back through and see, are there any revenues that we missed that we need to go ahead and get on the books? And so an example of this would be a company completes a job for a customer, let's say on January 31st, maybe 10 o'clock at night for $3,000. So it didn't get recorded with the regular daily journal entries or daily transactions because of when it was completed once the office was closed. So we would go back and do the adjusting entry, and that adjusting entry would be a debit to accounts receivable and a credit to service revenue. Basically, the adjusting entry would be, we're going to bill the customer, we're going to get the revenue on the books because we completed the job, so we can recognize the revenue. And it's just the total purpose of the adjusting entry is just to get the revenue on the books. Any revenue that we can recognize, we can go ahead and recognize it and get it on the books. So notice that this last adjusting, notice again, every single one of the adjusting entries we looked about either had a debit to an expense or a credit to a revenue account. That's a very important thing to remember about this process. And remember that this occurs after all the regular transactions have been recorded, but before the financial statements are or run. So adjusting entries are a good thing to understand and know, and make sure you understand these 7 types of adjusting entries because they are the typical ones that you're going to see over and over. So have a good day, have a good rest of the week, and take care. And that is all I have for adjusting entries.